Silver just dropped hard this week. In a matter of days, the price fell sharply, wiping out weeks of gains and triggering panic across the market. Red candles everywhere. Headlines calling it a breakdown, traders rushing to close positions, but here's the part no one is explaining clearly. While the price was falling, something else was happening behind the scenes that doesn't fit the usual pattern. Normally, when an asset crashes, demand cools off, sellers increase, supply becomes easier to find, and pressure eases. That is how markets are supposed to function. But this time as silver was sliding lower on the screen, exchange inventory data started showing unusual movements. Instead of supply building up inside major vaults, metal was quietly moving out. That contradiction is where this story really begins, because price is one signal, physical inventory is another, and when those two start moving in opposite directions, it usually means the surface narrative is incomplete. Most people only watch the chart. Very few watch the warehouse data, the delivery requests, and the structural shifts happening underneath. Over the past few sessions, heavy future selling pushed silver down aggressively during U.S. trading hours. Volume spiked, momentum traders piled in, stops were triggered. It looked like a classic liquidation event. But at the same time, registered inventories on major exchanges showed drawdowns that were not typical for a simple price correction. To understand why that matters, you need to understand how this market is structured. There's the paper market, where contracts trade in massive size every day. And there is the physical market, where actual metal is delivered and stored. Under normal conditions, these two move together. The futures price reflects real-world supply and demand. But when stress builds in the system, that alignment can begin to crack. And what makes this week unusual is not just the price drop, it is the timing of the inventory movement alongside it. When metal leaves exchange warehouses, it reduces immediately deliverable supply. That does not automatically mean a shortage. But historically, consistent withdrawals during periods of price weakness have preceded periods of heightened volatility. This does not guarantee a breakout, it does not guarantee a squeeze, but it does suggest that something more complex is unfolding than a simple sell-off when volatility increases and delivery interest rises at the same time. The market enters a different phase, one where paper positioning and physical demand are no longer moving in harmony, and that is why this moment deserves attention, not because silver went down, markets go down all the time, but because beneath that drop, the structural signals are not behaving the way they usually do, and when markets start behaving differently, that is when the real moves tend to begin. To see why this divergence matters, we need to zoom out and look at the mechanics. In the futures market, most contracts are never settled with physical delivery. They are opened, traded, and closed before expiration. That means price discovery is often driven by positioning, leverage, and short-term sentiment rather than immediate physical demand. When large players reduce exposure or increase short positions, price can move quickly even if the underlying physical flow has not changed much. At the same time, exchange inventories are divided into different categories. Some metal is eligible, meaning it meets standards but is not committed to delivery. Some is registered, meaning it is available to satisfy contracts. When registered inventory declines, it reduces the pool that can be delivered without delay, but does not automatically create a crisis. But it does tighten the system's flexibility. This week, as futures selling accelerated, warehouse reports showed metal moving out rather than building up. That is not the typical response to falling prices. In many corrections, lower prices attract less immediate withdrawal activity. Instead, this time, the drawdowns continued. That suggests at least some participants are choosing to take possession rather than roll contracts forward. There are a few possible explanations. One is that long-term holders are using the dip to secure physical metal, while short-term traders drive price lower. Another is that industrial users are locking in supply during weakness. A third is that large entities are reallocating inventory for reasons unrelated to speculation. The key point is not which explanation is correct. The key point is that price alone is not telling the full story. Historically, when paper volatility increases while physical availability tightens, the market often transitions into a more unstable phase. Sometimes that leads to sharp rebounds. Other times it results in extended consolidation with elevated premiums in certain regions. What it rarely leads to is calm, stable pricing immediately afterward. This is where most investors make a mistake. They react only to the headline move. They see a red week and assume demand has collapsed. But demand is not measured only by price. It is measured by delivery interest, warehouse movements, and lease rates. When those indicators begin flashing at the same time price falls, it suggests the correction may not be as straightforward as it appears. The bigger question is not whether silver dropped this week. The bigger question is whether the underlying structure is becoming more fragile. Because when flexibility in a market decreases, small shocks can create outsized reactions. And if physical supply continues tightening while leverage remains high in the futures market, Volatility does not disappear, it builds. As volatility increases, the next layer to watch is delivery behavior. When contracts approach expiration, traders have a choice. They can close the position, roll it forward, or stand for delivery. In normal conditions, only a small percentage choose delivery. The system depends on that. It is built on the assumption that most participants prefer financial settlement over physical metal, but when uncertainty rises, that preference can shift. Even a modest increase in delivery requests can place stress on available registered supply. The futures market is highly leveraged compared to the physical metal sitting in warehouses. That leverage works efficiently during stable periods, and during stress, it becomes a magnifier. We have seen versions of this dynamic before. In 2008, liquidity stress caused violent repricing across commodities. In 2020, temporary supply chain disruptions created unusual premiums and regional shortages, even when futures prices were volatile. And in past tightening cycles, metals have experienced sharp disconnects between paper pricing and physical availability. The pattern is not identical every time, but the common thread is structural pressure building beneath the surface. It starts quietly, warehouse levels trend lower, lease rates move higher, volatility clusters during specific trading sessions, and then at some point, the imbalance resolves, sometimes gradually, sometimes abruptly. Right now, what makes this situation worth watching is not a single data point, it is the alignment of several smaller signals: a sharp price correction, elevated trading volume, continued inventory movement, and increased attention on delivery dynamics. None of these alone confirm a breakout or a breakdown. Together, they suggest the market is not as relaxed as the chart alone, backed, might imply. The important thing to understand is that markets rarely give clear warnings in headlines. They signal through subtle shifts first: inventory trends, flow changes, behavioral adjustments among large participants. By the time the narrative becomes obvious, the move is usually well underway. Now the key question becomes, what happens next? There are realistically two paths from here, and understanding both keeps you from reacting emotionally. The first path is stabilization. Selling pressure fades, speculative positioning resets, and warehouse inventories begin to rebuild. In that scenario, the recent volatility becomes a short-term shakeout rather than the beginning of something larger. Price finds a base, premiums normalize, and the system regains balance. The second path is tighter supply meeting renewed demand. If delivery interest stays elevated while futures volatility remains high, pressure can build under the surface. In leverage markets, it does not take extreme conditions to create outsized moves. A relatively small imbalance between available supply and required delivery can trigger rapid repricing. That repricing does not have to be straight up. It can be chaotic first, with sharp swings in both directions. This is where patience becomes critical. When markets enter structural stress phases, short-term signals become noisy. Headlines exaggerate, social media amplifies extremes, traders overreact to intraday moves. But the deeper signals move more slowly. Inventory trends do not flip overnight. Delivery behavior shifts over weeks, not hours. Watching those slower indicators often gives a clearer picture than reacting to every red or green candle. If you hold physical metal, volatility in futures pricing does not automatically change the underlying asset. If you trade paper instruments, understanding leverage and counterparty exposure becomes more important during stress periods. And if you are simply observing, this is the time to study how markets behave when structure and sentiment begin to diverge. Because the real risk is not price moving. Price always moves. The real risk appears when flexibility inside the system declines. When inventory buffers shrink and leverage remains high, the margin for error becomes thinner. Small catalysts can produce larger reactions. That does not mean panic is justified. It means awareness is required. And this brings us back to the contradiction we started with. Price fell sharply, futures markets showed aggressive selling, yet beneath that move, inventory data and delivery behavior did not reflect a relaxed system. That does not prove a shortage. It does not guarantee a surge, but it does suggest that the surface story may be incomplete. Markets often appear calm right before volatility expands. They also appear broken right before they stabilize. The difference lies in the structure underneath. If inventories continue trending lower while leverage remains elevated, stress can compound quietly. If inventories stabilize and delivery interest fades, the recent drop may simply mark a reset. The mistake most participants make is choosing a side too early. They assume collapse or assume recovery without watching the underlying signals. A stronger approach is to monitor how price and physical data evolve together over the coming task sessions. Do inventories rebuild as price consolidates, or do withdrawals persist even if volatility slows? When markets begin to fracture, the first cracks are subtle. They show up in data before they show up in headlines. This week gave us a glimpse of that possibility. Not certainty, not confirmation, but a signal worth tracking. So the real question is simple. If price and physical flows continue moving in opposite directions, which one eventually adjusts? Does paper volatility fade and realign with inventory trends? Or does pricing shift to reflect tightening structure? That is what we will be watching next. If you want updates based on data rather than noise, stay connected and let me know in the comments what you think drives this market more. In the long run, leverage or delivery.